Hello, ladies and gentlemen. This is Fausto Puglisi from Cybertrade University. Let me get a quick audio check. Everybody give me a chat back. Let me hear you loud and clear. All right, good to see you. All right, Lita, good to see you. Rich, welcome. Ken, Chris, Gita, Fred, good to see you all. Jeff Hirsch, good to see you. Well, ladies and gentlemen, welcome to Closing Bell. I'm your host and president of Cybertrade University. I'd like to thank everyone taking the opportunity to come after this kind of flat market that we had going on today. I mean, some of you just came out of our afternoon meeting. We had a really good day trading in the morning. Afternoon, a couple of good movers here and there. Looks like it's been a pretty good January so far. But you know what? There's no better person that could explain the months, the days, the years than the gentleman himself, Jeff Hirsch, from the Trader's Almanac. For some of you who don't know or haven't seen him before, I know Jeff. It's got to be maybe close to about 10 years now. Met him several times at all the events at the money shows and have done events with him in the past. A lot of you probably have his book. I think everyone has their book, and you should. If you don't, you should have it. But it's great strategy. You've probably seen him on TV several times. But Jeff is here to kind of explain to you the technical, all the sectors, and talk a little bit about the strategies of stock trading, and and also about his book, explaining the benefits of why you should have it and how to utilize it, because once again, it's something that should be in everybody's library. So with that said, Jeff's going to go on, talk about an hour. He'll answer some questions at the end and close up afterwards. So Jeff, listen, thanks for coming, and hey, the stage is all yours. Give me a second. He's going to get his audio up and running, Jeff. Just waiting to get his mic working.
Why don't you just tell me to click it on then? Can you guys hear me now? Yes, thank you, Fausto. Sorry about that. I missed the simple step of clicking the X off the microphone in this particular platform, but I apologize. So thank you for having me, Fausto. Always a pleasure. Appreciate the intro. Thank you all for tuning in and for being supporters, readers of the book, Behavioral Finance, and all the wonderful benefits of stock market cycles, patterns, and trends, which is what we do. As Fausto was saying about how to use this book, well, all of the presentations I give are pretty much how to use the Stock Trader's Almanac. And I'm going to try to show you a few things, generally about the year, and then about the current, sell in May season, the best 6-month switching strategy. We've had our initial sell signal. I'll try to show you that. I'll see if I can switch over and show you some things from the website if need be. If not, you can track it down at stocktradersalmanac.com to see the latest things that we're doing and suggesting for folks to trade. So Fausto, you mentioned something about not a bad January. I think you meant June so far, right? And I think that maybe it was sort of a Freudian slip because we had a pretty solid January. That's one of the reasons we've been more bullish this year than we would normally be in a post-election year. But let's get rolling here. I'll see if I can advance these slides properly. A little word from the lawyers first. This is for informational purposes only. Not an offer to buy or sell any securities. Past performance not a guarantee of future success. Use your own due diligence, your own advisors, and be smart and use common sense. So this is the 50th anniversary edition of the Stock Traders Almanac. My illustrious father is 93 years old. Not quite what he used to be upstairs, but he's still above ground, and I do get to see him a bit. But we all have the privilege of standing on his shoulders, as the wonderful Isaac Newton quote says, and I personally have been able to see further, and I try to build, and I think you'll see from the January trifecta chart that I'll show you, we have added to Yale's iconic work, and without him, all these cycles, patterns, and trends would just not be in the forefront. He really put this whole seasonal behavioral finance on the Wall Street map, and is known for creating the best 6-month switching strategy, not just the old sell in May saw and the January barometer and the Santa Claus rally, and several other discoveries, and also publishing other people's findings with proper credit at all times, and trying to make it a little bit more attainable or reachable by people out there in the marketplace. Just a little look at some of the books that we've got out there. A little memory, little trip down the memory lane here. The 68 Almanac, which is the first one, is completed my set. We've got Yale's famous Don't Sell Stocks on Monday, which is something we still track with the days of the week. And one thing Fausto and I always see eye to eye on, I'm not going to touch on it too much today, as I look at my mouse pad that I have from Cyber Trading University, because it matches the half-hourly trading patterns that we have in the back of the Stock Traders Almanac and have been keeping there for years. Pages 139 and 140 for those of you following at home, following along at home. And this is one of the first things that I did as a Ute when I started getting my feet wet with the business, was running the numbers on the half-hourly trading, and it's just amazing, despite all of the high frequency and other bots and algos out there, that this 2:30 trading period is a great time to buy. You can see it on your mouse pad. I have one right here, and it really lines up well with what we've done in the Almanac. So just privilege and honor to have all these different books out there and be able to appear in different places. We're not going to get into some of the long-term stuff, the Super Boom book, but it is worth looking at for future reference. Just another trip down memory lane here. Shot of me and the big guy back about 13, 14 years ago, and then him on Wall Street Week after the big famous Dow 3420 prediction, which was the impetus for my 38,820. But that's just a little look at the past, and a little honorary mention of the big guy with our 50 years on the street. So we like to turn all this information into knowledge and wisdom. You can do it yourself with the Almanac, or you can come and see some of the things that we have to offer, ideas and suggestions, trading recommendations with buy, sell, stop, and limits, and different exact prices that we like things for individual stocks, sectors, and ETFs especially. One of the things that we do is provide the underlying, and I know a lot of people are options traders and do things with futures and other things like that, but you can take your own strategy and basically roll it over on top of our underlying analysis, whether it be buying gold for the worst 6 months, or going long a particular large cap stock in October when we're putting it out there, whether it's using options or some other sort of leverage. So we have an offer out here for the 50th anniversary and the worst 6 months. You can use these codes up here, and you get a free copy of the Almanac every year. It's $150 for 1 year, $250 for 2 years. Seems to be a pretty well-received deal. And we also do some other things for institutions and individuals. So just a little offer there for you in case you're interested. So our philosophy is that those who study market history are bound to profit from it. It's sort of a flip on the famous Santayana quote that those who fail to remember the past are condemned to repeat it. but we like to keep our friend Sam Stovall's words in our head that we use history as a guide, not as a gospel. And this is the trade setup mentality here. Just because it says sell in May and go away, and this is, as my buddy John Person said, doesn't mean you got to sell May 1st. And just because gold's supposed to rally in the fourth quarter doesn't mean you just buy it there. You look for the setup in the chart, set up fundamentally, and we sort of, cross our different 5 disciplines with psychological, technical, fundamental, monetary, and seasonal. Within monetary exists, geopolitics, and within fundamentals is both economic fundamentals and corporate. So those are the 5 basic things we look at. I really have a smile at the debate between fundamentals or technicals, and it's to me, why not use both? Or we do use both. So we've spent the last 50 years analyzing and researching every single trend imaginable. We publish it annually in the book. We update it weekly and monthly in our newsletter. There's also some stuff on the blog that you can track. We put a good bit of information out there for free. And we use all this knowledge to construct portfolios. We start with cycles and seasonalities and patterns for the most part, though I do reserve the right to pick a stock or a sector based upon other analysis that comes across, whether it's a good value, a good time, or something else that piques our interest. But for the most part, our bias is seasonals, and that's when we start picking our stocks, when the market sets up seasonally for the right opportunities. As I said, we look at current trends in the economy, monetary and government policy, and then we dig into market internals, and we had a little debate with our friend JC at All Star Charts, not debate, but just a little commentary on Twitter about new highs and new lows, and he put a little something out, and we think that that's important. And also the advanced decline line. There's a little piece we did recently on the sort of flattening or weakening advanced decline line as the market's going higher. So a couple of other things that we're looking at technically in the broad market. And then, digging down into old school fundamentals and technicals for individual stock picking. The major cycles, which we're not going to get too much into today, war and peace in the secular bull and bear markets. That's the big super boom forecast, which some of you probably heard about. We have been updating that recently, and it will be in the new Almanac for 2018. The 4-year cycle, we'll look at that in a little bit with the new Trump administration. The seasonals, of course. We're going to leave the quarterlies and monthlies and all the intraday stuff that I mentioned briefly for another time, and we will have a look at the January indicators because that is something that's impacting the market this year. So just to review the 4-year cycle, the 3rd year, the pre-election year, is the best. We had our first loss since 39 in 2015. Election years have been taken on the chin the last few decades with the 2000 undecided election, 08, the big recession, et cetera, so forth. And post-election years and midterm years are generally weaker. So we come into this year sort of being prepared for some disappointment, for things to happen, because there's this post-election year syndrome. We've seen a lot of big bad bear markets in the post-election year. We've seen most of the major wars begin, including 9/11, which was something that happened in a post-election year. However, it's not always horrible. After the 4 years after 29, where the market got hammered 4 years in a row, 33 was up pretty strong when FDR came in, and then also during the heydays of the dot-com era in the 80s and 90s, we had 4 straight up post-election years. Here we have 21st century. We had a couple of down ones. 09 was up, but we had a major bear market low. So looking at this, we're looking at a pretty solid post-election year here. Maybe we're at the beginning of that next secular boom and bull market that I've alluded to, but that remains to be seen, even though we do think we're off to the races on that. And that the 2016 January, February, what I call Ned Davis bear market, because it was only down 14%, but it was over the qualified for the Ned Davis rules, which we follow, 13% over 145 calendar days, peak to trough. We think that equates to our 1982 moment, and that's something that we've got more coverage on the website and in other presentations. But so what does Trump mean for stocks? You'd think under a Trump presidency with a Republican Congress, the market would perform better. As this table shows, Republican presidents, Republican Congress is 14.1% average. Believe it or not, Democratic presidents and Republican Congress are a little bit better, about 16%. above the average 8.3 years. So our expectation that sort of runs with our forecast was that things would be okay as long as the there weren't any major stumbles. Starting to wonder, and you'll see from a chart where maybe we're hitting that period in the year where the market and the country becomes a little impatient with what's going on in Washington. However, if we can get things done, less regulations across the board would be great. So far, it remains to be seen that any of that stuff is going to happen coming out of DC this year. So here's a look at these sort of one-year seasonal pattern charts updated through last week. We've got the post-election year pattern here. In the blue line is all post-election years, and pardon me, black line is all years, all first terms. We have a new president elected for the first time to office, and then first elected Democrats in the green line and first elected Republicans in the orange line, and then 2017 towering above it all. There's some reasons for that, but let's just look at this for a second. You can see the first 5 months. Are you guys able to see my mouse, or do I need to use some sort of tool to track that? If anyone wants to let me know. Do I have to use this little drawing thing? Oh, how about that? You can see the first 5 months tracked together for all of them, and then you see the separation right here in sort of June where we are now, and the nice, might be too far in California. That's funny. You can see the first elected Republicans. This sort of begins to diverge as we get into the second half of new Republican administrations. Post-election years are usually worse for Republicans because they tend to come in and sort of kick butt, take names, try to get things done, and it sort of tends to startle the market, whereas Democrats are a little bit more labored and take more time to get things through, and they tend to have a worse midterm year. But as you can see, let me see if I can use my blue pen again. You see the summer months here. This sort of really pronounced August through September and early October period that's kind of negative, and that's where we're coming in to right now. And with the things coming out of Washington at all different angles, I'm wondering whether we may get some impact here. However, it's not all bad news. It's actually mostly good news. But let's just look at where we thought we were coming into the year. Every year we put out a forecast in December just before Christmas. Usually do that last Thursday, and this year we did a sort of worst case, base case, best case scenario. And we gave a 5% chance to the worst case scenario with a mild bear market, recession, and Trump being complete letdown. The base case, which was 65% probability back in December, is now is up to more like 70, 75. Some moderate success, little real change, a lot of compromise, and growth remains tepid, and single-digit to low double-digit gains, which is kind of where we're at right now. Best case, he knocks it out of the park. Trimming regs and tax reform and healthcare and infrastructure, not so much so far. Would love to see it. So that's probably down to a 20 or 25% chance now, where economy accelerates and things pick up and we get a big bull market, maybe 20% or more. So that doesn't seem like it's necessarily the case. The best case probably staying in the base case area. Here's a look at the post-election years with this positive January trifecta. Now, I'm sure most of you know what the January barometer is. Yale invented it in 72. As January goes, so goes the year. It's based upon the 20th Amendment to the Constitution that moved Inauguration Day and new Congress's convening into January, along with everyone else's major decisions for the year and allocations. So when we combine the January barometer, which is the full month S&P, with the first 5 days early warning system, and the Santa Claus rally, the 7 trading day Santa Claus rally, the last 5 days of the year and the first 2 of the new year, not this rally that everyone talks about that goes from Halloween to Valentine's Day, which is not the Santa Claus rally. But in all seriousness, the combination, the standing on top of Yale's shoulders with putting together these 3 January early year indicators has been quite effective. So all 3 positive in the black line. Let's see how this, is that red dot at work? There you go. Whoops, sorry. All post-election years in the light blue line, and the purple line is positive trifectas in post-election years. Average gain of 24% for the S&P. Well, 2017 in red started out pretty solid. It's come back a little bit with some of the disappointments, but again, still on a pretty solid track for solid positive trifecta gains. And this is one of the things that's got us a little less concerned about the craziness coming out of the political arena on all sides of the pond. So one of the things, here's the 5 disciplines that I mentioned. You know, I don't expect you guys all to read this. Just as a look at an example of how we look at things. The updated ones on the website from the end of May. But psychological, fundamental, technical, monetary, seasonal, and things are still kind of in this area. The psychological is fading a little bit now. Fundamentals are still mixed. Technicals are getting pretty pricey. Interest rates haven't done much for us, but here we are in the worst 6 months and entering the end of the best 8 months for NASDAQ. So things are leaning towards the caution or risk off or defensive area for us, and you'll see it in our portfolios and what we're doing, how we've changed things. So for June, not such a hot month in post-election years. It's where as I said, NASDAQ's best 8 months ends, which is a great trading strategy. Everyone focuses on sell in May and go away, but as one of my favorite subscribers will tell, so I saw it at the Money Show recently. He takes the NASDAQ best 8 months signal that we put out in October or thereabouts when it triggers in his IRA, and he moved about $1.5 million into the Qs. And first year, I guess he told me about it, was 2014. He was up about 11%, 160K or so. This year he's in there, and he'll be looking for our seasonal sell signal sometime here in June once we get the trigger on the MACD. And it's really one of the perfect ways to use that strategy. I'm sure there's some leveraged options trade that one of you guys could do that might put more juice on it, but Qs are up pretty strong, and so is the market since our buy signal transpired in October of 2016. So a couple more points about June. NASDAQ's a little bit better, but it all sort of weakens in the post-election years. And while we started out pretty solid, you can see some of the numbers come down a little bit here. The big thing to look out for is the second triple witching week of the second triple witching week of the year, June, where we've got a lot of volatility, and you've got the Russell's rebalancing, and we've seen pretty nasty trading the week after triple witching, with the Dow down 24 to the last 27 years with some pretty sizable losses. And this quadruple or triple witching period is significant, where you see gains surrounding it in December and March, in the best 6 months, or June and September. Triple witching, third week, third Friday is pretty rough and on the negative, on the downside. So one of the things to watch out towards the end of this month. You can see that period right here in our little chart right out of the Almanac, the daily trading patterns where you see this week this year towards the end of June. So one of the things we put out, I wanted to show this to you on the website. I don't know if I can jump over there, but it was the blog post I did yesterday. You think I can go over there and take a quick look at it? Should I try the screen share? Is that going to be too confusing? Eric, you want to let me know as I talk about this? So, what we were looking at here is a pretty solid first 5 months of the year, and I wanted to see how that might impact, the rest of the year. And again, you can just go check it out in our blog, Almanac Trader, or stocktradersalmanac.com, and it'll click through. And I ran a table of all the first 5 months back to 1950 in the S&P, sorted it, and took the top 33 that were above the average 4% gain. And what you see is pretty amazing. It's only 1 year. It was 5 of them. Of the 33, only 5 were down. Only one of them was really nasty, which was 87. And only one of them ended up down, which was 2011. So again, it goes along with the January trifecta mentality. You know, gains beget gains. So we're seeing some pretty solid gains over the last 7 months, about 7.5%, 8%, following you know, a strong above average first 5 months. So while we are getting defensive and expecting some correction, perhaps the 5 to 10 or so percent change, maybe coming here, you know, June, July, August, maybe till August, September, we'll see what the news flow triggers. But it is prime for a pullback with the valuations, as I'm sure you guys all realize. But after that, I think we might close out the year with some strength and save the real trouble for next year. But that's another story and another presentation. So let me just get into the meat of the switching strategy and some of the moves we've made. This chart was initially put together to debunk the debunkers who like to go back and try to disprove the best 6 months or sell May and go back to 1896 when the Dow started, when it really wasn't in existence. Even though this sell on May is an old British saw, it's not that old, because they say coming back on St. Leger's Day, which is a horse race that's the final leg of the British Triple Crown, which has not been around that long. I mean, it is, but the sayings really reflects the sort of cultural behavior, seasonal behavior of human beings that drive the stock market. So in the red line is the years 1901 through 1949. You can see it's pretty much buy in May. And in the black line, it's 1950 through last year. And the green line is since the 87 crash, 88 to 2016. And what this highlights is a change in cultural behavior, where we had a mostly agrarian society of farming, where being in the northern hemisphere, most of this planting begins, except for winter wheat and that sort of stuff, begins in May. A lot of hiring and purchasing of seeds and fertilizer, and a lot of work done, equipment, and you can see it drives this economy and the stock market cash flows through harvest time. Post-World War II, we have the military-industrial complex and the service economy, and we see this sort of Memorial Day to Labor Day, and there's also a chart on the website showing the summer doldrums in volume here, which really drives this, or at least illustrates why the market goes nowhere, because people are doing other things. I mean, there's always the rumors of Wall Street hitting the Hamptons in the summer on Fridays, but it does happen, and people do divert some attention away from the stock market and finance and things like that during the summer months, and then come back in the end of the third quarter and kind of clean house and do window dressing and portfolio restructuring. So that's the basic framework of the pattern. Here's a couple of just illustrations. And I put in here the only proven black box system because a gentleman named David Aronson did a book back in 2008, evidence-based technical analysis. And you know, that's the buzzword now out there in the liquid alts area is evidence-based. And he, in his book with his partner, a PhD in math at Baruch, these are MTA guys, they took 6,200 or so black box systems, you know, algos and that sort of thing, put them through the scientific method, trying to disprove the null hypothesis that their results were the result of chance and not predictive. And what he found was that none of them were, but that the best 6 month switching strategy that my father created in 86, he started in 87, was the only one that proved to not be the result of chance and to have predictive power. So just using the basic end of October to end of April, you got 7.1 of the best months for most of the markets. Gains are made November to April versus 0.02 loss. That 10 grand gets a gain of 843,000 versus a loss of $100 and change. But when we layer in our MACD, which I'll show you on the chart in a little bit, it really juices up the returns. 8.9 on the percent change versus minus 1.8, and that same 10,000 compounds, the power of compounding, almost triples to almost $2.5 million. So simple MACD indicator, which is what we give our buy and sell signals on for the seasonal switching strategy, really has proven to be effective and productive over the past 50 years or 60 years or so. So what's our strategy? Well, I mean, the basic strategy in all trading and investing is, go against human emotion, sell your losers short, admit you're wrong, and then let your winners ride and admit you're right, and don't try to take profits quickly. So that's the key. So in May, June, when we start getting these sell signals, we do sell some things, but we don't go away. We'll be long stocks in the best months, short stocks in the worst months. We're looking at shorts right now. We like to wait until we get our NASDAQ signal, sell signal these days, and try not to short into any of that early first month of the third quarter strength in July, and look for some setups there, maybe in some of the weaker sectors in the worst 6 months, like materials and that sort of thing. We've already begun to take some defensive positions in bonds and in metals. As I mentioned, we use some other technical tools. I'm not going to get into all the different techniques and strategies with options and leverage, but basically it's a risk-off time of year for us, defensive versus aggressive, and that's where we're sitting right now, sort of between the S&P Dow sell signal and the NASDAQ sell signal, which is hasn't triggered yet, but if we keep going sideways here, it might just trigger at a nice easy level. So here's just a look at the chart of the S&P with the two MACDs we use on there and a couple of highlighted points. I didn't put the current sell signal on there, but it was May 17th, right in this area where you get that second crossover. We were negative coming into since March, and then we went positive, and we were waiting through April and May to get confirmed between, I don't know if you can see this, it's small for me the way I'm looking at it with the full windows open, but it's 817.9 for the buy side and 1226.9, which is something not everyone uses for MACD. Everyone's pretty much focused on the 1226, but as we know, tops are a process and take longer than bottoms. Bottoms are these events that transpire, and we use the faster MACD, the shorter time frame, 817.9, to capture those buy points. On the sell side, the top is the longer one, the 1226.9, and we also we make sure that when the sell signal is the sell indicator MACD is signaling sell, that the buy is not signaling buy. And for the best 6 months, we want to have the Dow and the S&P in agreement, and on the sell side. And then back in October or so, we're looking for agreement between NASDAQ, S&P, Dow, and between all three of their buy MACDs and sell MACDs. So just a little extra layer to make sure we're not moving too quickly or too slowly. And that's where we're at now. As I mentioned, we had our sell signal on May 17th, and you can go check that out on our website at stocktradersalmanac.com. So the sector rotation strategy, here we've got the bullish sectors highlighted during October, but you can see up here in April, May, we've got some shorts, and then you can see there's the gold and silver long, but on the commodity side, we're already in the gold and silver SLV and the GLD. Material short is very interesting. That's been really consistent, and I'll show you what that looks like just in a second. And some of the top sectors that for the worst 6 months, people are always wondering where to put their money. It's a big question on TV and that sort of thing. And looking at this, we wanted to just not look at average gain or median gain. We've got some different monthly performances here also, but I think the takeaway here is the win ratio, or the plurality of gains. Whereas biotech's pretty strong, however, it's only up half the time. Whereas you come down a little bit to consumer staples and bonds is more consistent. So if you're looking for a place to park some cash, you know, and put it to work. On the long side, you know, it might be in bonds or in healthcare and consumer staples and that sort of thing. Whereas at the bottom end of it, you see some of the different lower, you know, underperforming sectors. As I said, materials is down here at the bottom. So let's look at the example of, you know, materials being long and short. Again, our favorite one-year seasonal pattern look at things. We've got the, you know, sort of negative period, the bearish season, obviously very similar to sell May and go away, May through October. Pretty weak for materials. October through May with a little January break is still pretty strong. So when we take that similar exercise and do the annualized performance for sector rotation, meaning long the bull season, short the bear season versus buy and hold, you get 15% versus 5%. And that same 10,000 in the rotation, long the bullish season, short the bear season, gain of 377,000 versus a gain of about 40K for buy and hold. So just a nice illustration of the benefits of seasonal trading, long and short in a particular sector like materials. Now here's where we're at as of May 23rd. Let me see. I'm going to blow mine up so I can see what I'm doing here. You can see a lot of the long SPY stuff comes in from September, October. Energy is a play. This oil tends to make a low in December. That one didn't work out so well for us. Not all winners. A little shorts in gold and silver. We sold them and covered these as we got into. Let me go back. Shouldn't have clicked on that mouse. Sorry about that, guys. As we got our buy signal here on the 17th, we picked up gold, silver, the bonds, the TLT, as well as the AGG, which I like very much. Utilities is good for the worst 6 months. Tough trade for us, just because it kept running away on us. We wanted to get it lower. Financials are coming back here, so we do own most of these things that you can see in the bottom, but gold and silver is up even more since this update a couple weeks ago. So that's working out well. Everyone's talking about bonds and gold and silver. We've been in it for this first 6 months for some time. So here's this little treasury rally. Here's the futures out of the Trade Navigator software. You can see the seasonal period from late April into September, late August, and we had a buy limit down here at 117, and it just wasn't didn't come and get it for us. So when we got the buy signal for the sell signal for the worst 6 months, best 6 months, we jumped in about 123.50 for the TLT. And then I want to just share with you a little pound trading. I don't know if any of you people are trading currencies. I don't trade futures per se, but I've had some success with the pound, especially because it's got a very strong seasonal move. And when you get these events that exacerbate them, like Brexit and the discussions about it, it does make for some nice setups. And we've got a little, combination of technicals and seasonals here and fundamentals. You can see the big Brexit drop over here on the left side of the screen, and then they were discussing all of the concerns and fears about Brexit, and everyone was sort of freaking out with the pound. And this sell-off here back before the election set up a nice, and I talked about this in Dallas, I think, when I think Dwayne's on the line, or was before, at the Money Show. I know one of my attendees there was really psyched because he got into this. You can see the seasonal trend from, you know, the fourth quarter when there's a lot of spending going on in England and the holidays and that sort of thing. A lot of people traveling to the UK for the holidays, and we had a nice trade here. And then what sets up here in the spring, which is something we're still into here, is this end of the fiscal year. UK fiscal is March 30th, begins April 1, and it drives some repatriation of funds back into the UK. And you can see this seasonal setup here. Well, we had some additional Brexit fears and chatter going on at the time, and it set this move up nicely. We got into it. I'm in it a little bit lower at about the FXB at about 118.64, something like that. And then you're supposed to get out of this trade at the end of April. However, we see the setup of this W123 swing bottom, and it breaks above the middle of the W, which is a buy signal, as we're in our seasonal thing. So we hung on to this. Probably could have taken a little off the table up here, but we're going to stick with it until this thing breaks down. We have a stop loss here at the December high of about 124.50 for the FXB, which is different than the actual British pound. But this is the underlying commodity. So that's a combo setup, seasonal setup, trade setup with a technical confirmation to hold on to it, and just one of the things we like to do, combining the 5 disciplines. So I want to just get into some of our stocks, and I think the key is the seasonal overlay. Again, I'm proud of our screen. I think it's sound and really solid, but the juice kind of comes from the timing of the purchases. I know people are always looking for a stock every month in their newsletter or whatever, but we stick to our bias, our mentality, and we find that going long in October or even August or September, and whenever we get that correction, we'll pick our basket of fundamentally screened stocks, and we go short in the summer. And also, even if we get like a big sell-off like we had in, say, in 09, we'll get into some stocks there after the turn in like March. And even the sell-off we had in 2016, we put out another basket there in February, March. So on top of the seasonal overlay, excuse me, we do a big screen, and I do it by hand out of Zach's research wizard, about 24 or so different criteria, looking for fundamental growth and revenue growth and acceleration, earnings growth and acceleration, decent margins, good valuations, low PEs or relatively low compared to the S&P or their sector. Same thing with price to sales, cash flow, and all these other things. We put them into 3 different categories: small, mid, and large cap. Small is under $1 billion, mid is $1.5 billion, and large for us is over 5. And I guess once we get into picking the stocks, we look at the chart patterns and look for buy points using some old school tactical stuff. But I think one of the wrinkles that, all things being equal, with any two stocks roughly around the same price, same sector, whatever it might be, equivalent fundamental numbers, but one of them's got 20 different analysts following it. One of them's got 3 or 4 or 5 or whatever, a small amount. We're going to take the one with less followers because we're going to get a little bit of edge on the street. When our sound fundamental analysis becomes recognized by the street, people will jump on, help drive the stock up. And also, we don't have to compete with the wirehouses and other big analysts who are, driving things or pushing, the agenda on the stock purchases. So we like to find these stocks with great numbers, great chart setups, but also just a few Wall Street analysts following it, not so many. Doesn't mean I won't buy Apple if it comes around, but we prefer to stay a little bit under the radar, sort of underdiscovered, underappreciated stocks. So just a look at the different stocks we have in there. This is from the 10th of April. There was an updated one, but some of these are up even more. You can see the kinds of stocks we have here. Pressure Biosciences was a little biotech that's actually been sold here. I own some of that. That was a seed purchase non-seasonally, something I discovered down at the Orlando Money Show. 15-cent stock. I sold half on a double. It's a great little trade. It's sort of breaking down here a little bit, only up about 50%. Rocky Mountain Chocolate and Hershey is a cocoa trade. These are highly correlated stocks to the when cocoa prices go down, these do better. These are both up a little bit more from where they are right here. You can see our big cannabis play here, Scott's Miracle-Gro. Believe it or not, we didn't necessarily realize at the time in 2015, but here we are letting our winter ride. But it seems to be all the growers are using Scott's Miracle-Gro. So there's sort of your real pure play cannabis, not these fly-by-night things with no revenues or anything, but something that's actually got 10Q numbers and revenues and earnings. United Health we've been hanging on to for a while. The copper trade here, Southern Copper and Global Brass and Copper Holdings. Again, a seasonal commodity correlated trade. These are two copper producers, again, hanging on to them for quite some time, letting our winners ride here. Big winner, this stock, Arista Networks. Whoops, sorry about that, kids. Old fat finger discount. Arista is up about 150 or so. Huge large cap win for us. Just a great technology company. And you can see some of the other ones that we've been holding. And the updated one from later in May is, of course, on the website at stocktradersalmanac.com. So all of that has produced these kind of numbers. Kind of proud of this. Our stock portfolio is up 423% since 2016. It's up even more now, versus 165 for the Russell in the blue and 83% for the S&P. Going to leave some time here for questions, but before I go, just remember, if you want to join us, get your free almanacs, the 2017s while supplies last, and of course the annual one when it comes out. 150 for 1 year in honor of the 50th, 250 for 2 years, also in honor of the 50th, and you can use this code here, 2YR50WSM for worst 6 months. And with that, I'm gonna open the floor to questions, and hopefully I gave you a few things to think about. And if you have a specific question about something we didn't cover or you're wondering about, you can shoot now or contact me through the website and take a look and see what we have to offer there. And that's it. Thanks very much, and I'll take your questions. Or not. Let me see if I can scroll down here. Can you bring up the slide with the codes? Surely enough. And if those don't work, for some reason there's an error or an issue, I will be happy to issue you a new code, maybe something like CTU in it. But that is what we have there. You're welcome, Richard. Maybe while here, I'll just type the codes in here. 1YR 50 WSM and 2 or got it. Let me see if I can pull up some things on our I'm gonna try to screen share with you. So it might look a little bit screwy in the beginning. You're welcome, Elaine. If there's a question that pops up while I jump away, just sort of somebody give me a holler in my ear. Let's see. Appreciate that, Elaine. So this is going to get double duty right here, but I'm going to jump over and show you some things. Yeah, see, let me just go over to. So here's our tactical switching strategy. Sell signal on the 17th. And I'm just going to show you the kinds of, specific advice. We're talking about selling the diamond spiders, REITs we didn't like anymore, transports, consumer discretionary, holding on to tech and small cap related stocks as the best 8 months are still going on, and staples and healthcare. And we picked up half positions in the treasuries and the regular bonds, the corporate bonds, the big aggregate bond thing, and utilities we added, as well as gold and silver. So pretty solid look there. Here's the updates from 22nd, which I showed you. You can see, well, this is newer. So we got the stock and ETFs. Here's that volume chart I was talking about. That's what I want to show you. Here's the You can see how the volume sort of dips down here in the summer doldrum stack. There are other, see, this is Christmas time and everyone's off. You can see some other spikes here, but see, this is from last month. You can see Arista's up to about 142. It's up even more than that since this update. And here's the website. You can see, oh, here's that table, the first 5 months versus the rest of the year. I know I have a problem with long tables, but I like to look at everything, so you'll have to bear with me. But you can see only 2011. These are all the ones that were up above 4%. Couple of pullbacks here. Does trouble me that we're in the 7% area where there's two other gains here, but that's a little anecdotal. And you can see 87 was the only one to really give a lot back. 75 just kind of flat for the rest of the year. 86 a post-election year. That's a pre-election year there. So let me see if anyone chimed in with a question while I was searching around. Let's see. Appreciate, my pleasure, Pamela, Stephen. So how does your subscription work? Yes, we email you the articles that I just showed you. You can get them on the website. You have full access to everything that we've come up with. Some of the archives are available to the public, but that's way back. And you get a free copy of the Stock Traders Almanac. And we will be adding probably bi-weekly webinars. And we provide here, let me give you a little look at the subscription there. So if I go back to the, let's see, the main, you'll see our list of alerts. These are all gets emailed to you. Here's the advanced decline line. I better log in here. A little look at the 80 line I was talking about here, kind of flattening out. This is the best 8 months update. Our market at a glance, the current one. Fading, mixed, topping, neutral. Sentiment. So these are the things that come into your email that are also available on the website here. Here's a look at my 3 peaks in the domed house top pattern, which we've updated, kind of showing a potential rollover here. Doesn't have to be that bad though. Little pulse of the market. We run down the different items that comes right out of the back of the Almanac. The different internals that we talk about, put call, little sentiment in there, psychology, whatever you want to refer to. So those are the kinds of things we're putting out there. And just give you here's our strategy calendar. Bullish and bearish days, different highlights of economic releases for the month, triple witching as we talk about, a week after triple witching, see. Big warning there, a couple of bearish days toward the end of the month. Let me just jump back and see who's did a June SPX vertical call credit spread today. I think it matches your charts and info. Vertical call, that's a vertical bull call, right? So you bought something just above the SPX and sold something above that. We do follow non-US markets, not as much as people would like. Whoops. But we're looking at doing more. I did some work over in Hong Kong, and we ran a whole bunch of seasonal stuff. Found some interesting things related to the seasonality around Chinese New Year. And we are looking into more things for Europe, the UK, and Canada and Asia. Emerging markets. I don't know if we've got the data available, but it's something we're looking at into. We're also putting out. Good. Thanks, Stephen. Yeah, just watch out for that June triple witching. But I think you got a little, because Nasdaq is really embedded into the SPX now, so you've got that tech move. As I was saying, we are going to be putting out another Commodity Traders Almanac for those of you that do know what that is. Hopefully be teaming up with our buddy John Person. He and I got to get together on the horn, and hopefully over the summer we can get that out and have it ready for people in the fall for 2018. Maybe we can get, since we're going to be doing it ourselves, so we'll have a little bit faster turnaround time than the major machines of the major publishers. Let's see, what else can I show you? I've got my Trade Navigator open, do I? So here's the gold. We got a stop down here at 115. This is the GLD. The 17th is right here. So we bought it right up here. And we're getting a nice little up move on that. You don't want to be seeing my email popping in, do you? Here we go. Let's see. Anybody else chiming in? So I guess okay, you can see the calendar. Well, hopefully you'll come and join us, Stephen. And again, you know, I'm gonna let you guys go. It's 5:30 here. As they say, you know, tell them what you're gonna tell them. Tell them what you told them, and get them out early. So unless you guys want to chime in on a few more questions, I think I'll let you go. And if you can always follow up with me through the website, stocktradersalmanac.com, and I'll reach out to you guys and you know, keep you informed as to what we're doing. Appreciate it, and thanks again, Dwayne. Hopefully we'll see you back down south on in Deep Ellum pretty soon. So with that, I'll let you go. I'll thank my buddy Fausto, Eric for setting things up, and the rest of the team back there at Cyber Trading U out in the island. And hopefully we'll be seeing each other in person sometime soon. And enjoy your summer, people. Be patient. Cash is a position. Good night.